You're listening to the Wealth Mindset Show, where Hicks and Zerker Capital Management's team of finance professionals, portfolio managers, and a life coach come together to tackle complex topics in finance and retirement planning so you don't have to. From investment strategies and wealth management to tax planning, retirement income, and aligning your money with your values and purpose, the Wealth Mindset Show offers the tools to thrive.
All right. Hey, welcome to the Wealth Mindset Show, where our Hicks and Zerker team will have conversations on managing wealth, navigating retirement, and making smart decisions for a secure, meaningful future. I'm Austin Wilson, Director of Investments at Hicks and Zerker Capital Management.
I'm Josh Robb, Director of Wealth Management at Hicks and Zerker Capital Management. Today, we got two people joining us. We have Tony Hickson and we have Jordan Shaw here.
Oh, yeah.
So today, we are talking about protecting retirement money from market volatility. So really what we're looking at here is specifically people heading into retirement or into retirement. They tend to view that money differently than while they're working and saving. So how can they best protect it from market volatility? But also, I'm going to start with this. What's volatility?
Okay. I have some thoughts about this,
yes,
as you may expect. But volatility is really large moves. And the way that you can think about volatility when it comes to your investments is it's inevitable, for one. It's not a risk-free asset.
Mm-hmm.
And it's the price you pay for getting a return above the risk-free asset, right? So when I'm talking about the risk-free asset, I'm talking about essentially really short-term treasury bills, cash, essentially, money market funds. Anything above that is going to have some level of volatility associated to it because there's some risk to it. And the more risk you take, the more your return is going to be over the long term, but more in the short term, you have the opportunity for things to go up or down really wildly.
And that's important because volatility is movement.
Yeah.
It's not a bad thing.
Correct.
Volatility itself is movement of an investment, in this case, what we're talking about, up and down.
Yeah.
And so when I say this has a lot of volatility, it means it goes both directions more so than something else we're comparing against.
And that's actually one thing when you think about stocks are obviously associated for having high volatility.
Mm-hmm.
Bonds, less so, but still some volatility, right? But it goes both ways to that point of, no one complains about volatility when their portfolio goes up 30% a year, which does happen.
Yep.
That's volatility, though.
Yes.
And it's also volatility when your portfolio goes down 30% in a year.
Yep.
And bonds also have moves both positively and negatively, and they're just much less magnitude. So you may have a good bond year that's up 5.
Yes.
And you may have a bad bond year, and you're like, oh my goodness, I'm down 5 until 2022. But that's beside the point.
Yeah. All right. So now we understand volatility. And Jordan, maybe you and I and Tony, from an advisor standpoint, why do retirees look at this differently?
Yeah, well, I think this is largely a matter of how you feel in retirement. So it goes from, your portfolio goes from something that maybe you just continue to put money towards and you check it every now and then to suddenly it's a source of income and it's providing for your needs in a large part.
Yeah.
And also, it feels like it shouldn't happen when you do need it. Because you haven't been watching it so much, you don't realize that it not only should happen because it's normal, but it's so routine that you're not paying attention to it. But when you're afraid of something like volatility in retirement because it's providing for you, you're looking for it often, so you're going to see it more.
Yeah. When
you're afraid of something, you see something often, you see it all the time when you're checking. So I think that's a big part of it. It's not only feeling like it shouldn't happen, but it's something that you're constantly looking for too.
Yeah, if you were, while you're working, used to maybe once a year just kind of doing a review and reallocating or adjusting things, you may have missed the volatility that year because you looked at the end of the year and July it was down 15%, but you never saw it because when you look at the end of the year, it's there.
Yeah, and to your point, you never saw it because you were employed.
Mm-hmm.
So you're working, you're doing your job.
You don't need it.
40 hours plus a week, and you're not focused on the markets. And oftentimes what retirees do is find themselves with nothing but time. And so they're checking the news, they're checking the Dow Jones averages, they're looking at their apps, and they're finding that that they're more fixated on the swings and the volatility in the markets because they have time to do that.
Another thing that's interesting is when you are working, you're typically putting money into the market.
Yeah.
Right? So that kind of mutes the impact of volatility. So if the market goes down 10%, but you'd put a couple $1,000 contribution in, you didn't go down that much, your portfolio value. So you see less of those blips, and it allows you to do something that we love in this industry, and that's dollar cost average, right? So you're putting money in, and you're buying the dips, and you're buying less when it's expensive and more when it's cheap, and it really smooths out that ride when you're putting money in. But things look a lot different mentally when you start pulling money out, and that brings us to our next topic, which is sequence of returns.
Yes.
And that matters a lot in the retirement world. So
yeah.
Josh, kind of just explain what that means.
Yeah. So this is where we can get a little deep into the statistics and numbers and kind of the back end of retirement planning. But this is important to understand because sequence of return risk is the concept that when you start drawing from your portfolio, what happens to the market when you start drawing matters. In other words, if I retired in 2022, January 2022, and started drawing on my portfolio, I experienced down markets, both in fixed income and in stocks, and I'm drawing out of my portfolio. So I'm not adding any new money in, like you were talking about. I'm taking money out, and I'm taking money out at a lower point. And in fact, I saw the side-by-side comparison where they just inverted the returns. So they had the same average return. So it's the same returns for a 20-year period. They just flip-flopped it, and they had bad returns at the beginning, first 3 years, or bad returns at the end, last 3 years, and they averaged like a 5% return when you put it all in. Started with $1 million. The one that had 3 bad years at the front end ran out of money in the 19th year.
Yeah.
The other one ended with, I think it was like $600,000 still.
Wow. Yeah.
Well, big difference. And you had the same average return, the exact same returns year by year, but just in a different order. And that's what sequence of return is how and when do you get your good years and bad years? If I get those at the tail end of my retirement, less of an impact than on the front end. So how do you stop that? How do you protect from it? Those are some of the things we'll talk about coming up because that's something you can't control.
Oh, absolutely.
You may be able to go back to work or do things to offset it, and that's one of the things you can do, but you don't know what's coming when you hit that retirement, right? Somebody who retired in 2007 didn't know 2008 and 2009 was showing up, right? And I'm sure there's people then that had to make some tough decisions to get back on track.
One of the reasons that's so complicated for especially those early years of retirement is you think about pulling money out when markets are down and going down and continue to go down, which happens. Okay, we haven't felt that in a while. It's been a few years now. But markets do go down sometimes. And when you pull them out, that's great because you have to live on it. That's okay. We understand that. But those dollars that you pull out at a low basis don't have the opportunity to get back to where they were. And they will. The markets do heal. The markets do recover over time. Typically, it takes 2 or 3 years for that to happen. But those dollars could have been pulled back out when the markets are much higher. Yep. But you're taking away the opportunity for that, which is why it's so detrimental to your long-term returns.
Right. Because if it takes 2 to 3 years and you're taking 4 to 5% out, that's 15% of your portfolio because normal retirement, you count on some growth to offset that withdrawal. But if it's flat to down, you have taken out a fifth of your portfolio potentially in that short time period. It's not good.
Not good.
Yeah.
You did say, Austin, that markets do heal.
They do.
Yeah.
But what I've often found is that retirees will say the 4 most dangerous words in our industry.
This time's different.
This time is different.
This time is different.
This time it won't recover.
Right.
This time it won't heal.
Yeah.
But history would reveal it always does.
We have over 100 years of publicly traded stock return data and bond return data for that matter in the United States. And much longer if we go back outside the United States. And we know that it has happened. And sometimes it's been longer than 2 or 3 years.
Sure, yeah.
But it has always happened, and we can sleep at night knowing that it will happen. And there are a lot of things we're going to talk about here towards the end of the episode of ways we can mitigate that risk a little bit. But right now, we need to be talking about what are some things not to do.
Okay.
If we experience market volatility, we're afraid of it. So this
advice not to take.
Don't take this advice. This is not a recommendation.
Listen to the disclaimers at the end.
So what do you not do, Josh?
Yes.
Anything funny?
Well, the first thing would be to put all your money in crypto and say, this is it. I'm going to get everything back. Yeah, it's going to the moon and all the other short phrases that young people say that I don't know.
Over the last 9 months, that actually would have worked.
Yes.
Yeah.
And that's the thing.
That hope would have worked.
Recency bias. Cryptocurrency is a new, I don't know what you call it. It's not technically an investment.
It's an asset.
Speculation.
Mm-hmm.
And because it's new technology, there's been a lot of movement. And so it's had a great run. There's no guarantee going forward, especially when you're unregulated, which is what crypto is right now. And so that's something you should not do and extrapolate that out. It's not just crypto. It's saying I need to take a lot more risk to catch back up. Again, that's not the answer. Taking a ton more risk is not the answer.
I think when you're thinking about crypto specifically, because it's people talk about it and ask us about it all the time, is we don't have that 100-year history to understand how things work over long time periods. We have a very short history. We're talking 10, 15 years on a lot of these major cryptocurrencies. That's not enough to know how market cycles work in crypto. So that's a great example of maybe what not to do. Anyone else? What don't you do when you're afraid of volatility?
Well, go the other route.
Okay.
I'm going to sell everything, buy gold, buy
gold.
something.
People love gold.
And bury it in my backyard or put it in my safe or whatever you do with it.
So funny story.
Yes.
I had a prospect cash out their 401k and put it into gold and bury it in their backyard.
Yep.
So
because this is it happens.
It happens. Yeah. When you get freaked out on what's going on in the market, gold tends to make its way through the financial commercials.
Why is that?
Yeah, because it's the safe haven assets. It's tangible.
Yep. It's value. It's always going to have
value to it.
It's limited. Yeah. There's only a certain amount of gold in the world.
But guess what I asked him when he told me that's what he was going to do? I said, draw a map.
Yeah, that's right. That's a good point.
Get it to
X marks the spot.
To a family member, because ultimately we're going to need to dig that up someday. So.
Yes.
That's another interesting asset class that has a unique history. And we actually don't have that long of a history where the dollar wasn't pegged to gold, right? So we're only going back to the 70s where we have a history where gold actually fluctuates like majorly in price. Mm-hmm. So we don't have the 100-year history to draw on that. And if, recent history has told us anything, gold is a bad inflation hedge anyway, and it just doesn't have any earnings and interest-bearing properties. So that's why we're typically not fans of it. Yep. So any other examples of what not to do?
Well, I think a good one would be to just cash everything out and move into your kid's basement.
Ooh.
Yeah. They'll take care of me. I take care of them.
Absolutely.
That's right.
So we've been in business 23 years. Any stories? I hope there's not a story where a client has had to do that. But
I will say, not to that extreme, but the mindset of someone else will take care of me is out there.
That's true.
And I think that's kind of where that's at.
We've done pretty well with avoiding that one. So
I'm sorry if my parents have to move into mine.
Yeah. The idea though is that, there's a safety net, which is true. There are some things built into our society, which is a good thing. But that's not the answer to this volatility of just kind of, in a sense, ignoring it and not doing anything and just saying someone else will take care of me, which I don't think is the best solution.
So we kind of talked a little bit jokingly, but a lot of that was real about what not to do for volatility. What are things we should do? So let's talk about how we can adjust our portfolio to prepare it for retirement ultimately. So think about a couple years going into retirement, maybe a couple years starting retirement. What are some things we should do there?
Yeah, Jordan, we do this a lot with clients. We recommend a strategy, but walk us through kind of the last 2 years maybe before retirement, kind of what we start doing when positioning clients.
Yeah, well, it's something that you can start thinking about well before retirement, but the action points really start coming into effect right there in the last couple years before retirement. And it's not these huge transitions like some people might think, like, okay, I'm going to be extremely conservative. I'm going to put everything in cash or some fixed income investment. But it's understanding less about your asset allocation, more about what are you willing to take on with the risk that you're going to, the changes in your mind and your mentality and your lifestyle that are going to present themselves when you're coming up on retirement, that fear that's going to come into play. And how does your portfolio complement that and help answer some of those fears? And that may mean, okay, we're going to be a little more conservative so you don't see or feel those fluctuations, that volatility as severely. But it's also the same thing that we've been doing all along. It's you have a long-term plan for your portfolio from day one. And assuming that's the case, you're going to be ready when that time comes.
And even tactically, Josh, we employ a bear market fund.
Yes.
So you want to talk a little bit about how we do that for our clients?
Yeah. So for us, we titled a bear market fund for the idea that bear markets happen for everybody, including retirees. They're going to experience 2 to 3 throughout the retirement years or more. And so a bear market fund is just the idea that we know you're withdrawing out of the portfolio. We know that regardless of what the market's doing, you do have income needs. So if we have 2 to 3 years of your living expenses, the withdrawal needs, set aside in a less volatile, and again, volatility is both directions. So you're giving up some returns, but you're also capping that downside return to the extent versus your high volatile things. Putting 2 to 3 years of your needs aside gives you that ability to ride through those downturns. So the market drops and you say, oh no, I have to take out of my portfolio. Well, I got 2 years that's not experienced the same level of volatility. I can live off of that and let the market recover. So now I'm not drawing out of the down assets. I'm drawing out assets that have that less market movement. So that's the way we've done it. It's, for a lot of people, if you're in a balanced, diversified portfolio, you probably already have that built in. We found carving it out and putting it in its own account just helps you see it. It's just a visualization. You're in a 70-30, 60-40 allocation where you have stocks and bonds. That bonds is really that piece we're talking about. So most people have this, but we found psychologically, it really helps just to see it. Hey, that's 2 years that I could be indifferent to market movement. 2 years where the stock market can do anything and it doesn't affect me and my lifestyle. So yeah, that's what we've done to practically imply that. And going back to that stability versus growth piece is that concept of I have to give up some of that upside volatility to protect the downside.
Yep.
So you don't want to put 10 years in something like this, because what you're going to do is limit your growth potential, which then limits what you can do in the future to combat inflation, which is the biggest thing retirees fight against out their whole life.
Have you ever thought about how your financial choices reflect what truly matters to you? At Hixson Zuercher Capital Management, we believe that integrating your values and dreams with your financial future is key to achieving peace of mind and confidence. When you engage in deep conversations with us, you'll start to see how your money can support the things that matter the most in your life. Our holistic approach means that your financial plan is more than just numbers. It's a personalized blueprint that evolves with you. You'll have a dedicated team of professionals tailored to your unique needs, all focused on crafting an investment portfolio designed to help you achieve your specific goals. Plus, our on-staff retirement life coach offers guidance to empower you toward a fulfilling retirement that goes beyond just financial security. Ready to transform your relationship with money? Join us at hzcapital.com and let's embark on this journey together. Now, back to the show.
So Josh, I'm going to tee you up here.
Okay.
How much cash should retirees have on hand?
The answer is, it depends.
Oh, man.
Oh,
But
Who
the-
could have
the-
seen that one coming?
The truth is, it's different for everyone. But
Yeah.
what I always say is, how much do you need to sleep at night and not wake up in a panic? That's the answer. And everybody's different. There's some that say I need a year's worth or I need X amount. Some just say, if I just have enough that, I can a couple months, I'm good. And some just say, I don't really need anything. You're sending me my check. I'm good to go. So cash to a lot of people is that peace of mind, right? It's not doing anything right now. It doesn't go up or down. It just sits there. So I know I don't have to stress during that time frame. And it's different for everybody.
I would say, as a word of caution, cash isn't an investment.
Yeah, so not 50%.
So yeah,
Yeah.
there are levels where it's going to obviously have very, very little return over any time period, but especially over a long term, and it will be eroded.
It
by
doesn't keep up
inflation,
with inflation,
right?
yeah.
That's the key word there. So to the point that you can have enough cash or cash-like really conservative bond investments to sleep at night, but also keep as much invested in growth-oriented or your equity side of things, long-term thinking. That's really where the balance is. But let's change gears just a little bit and talk about withdrawals, right?
Yeah.
So obviously you're gearing up for retirement. You spend a lot of your life putting money into investments. Well, then you flip a switch. You're retired and you need to start living on those. So withdrawal strategy is obviously a very huge component of a retiree's success or failure ultimately with their financial plan. So how can a well-planned financial plan have, incorporate a successful withdrawal strategy?
Yeah, and it comes to a couple things, and we've talked about this in other podcasts before, is it needs to be sustainable. Your withdrawal rate really matters. How much you take out is a big piece. And I know, Tony, for you and I, as we worked with clients, that starting point matters because every client's like, well, I'll enjoy it now and then I'll cut spending later. And we've seen and we know that's a hard thing to do.
Yeah,
some people do it.
And then oftentimes they increase it.
Yes. So
They don't cut.
starting point matters, what your starting withdrawal rate is, but then having a strategy of how and when you fund it is important. Now, I know you and I have done different things with different clients. You want to explain maybe one or two of those that may resonate with people on a process to generate that?
Yeah. The one that comes to mind is, hopefully it doesn't make it too complex, but it's basically an endowment concept where we take a rolling average of balances over the past 12 quarters and that smooths out volatility. That's 3 years of returns, and we're able to overlay then a withdrawal rate, a rate that the portfolio would be able to sustain. And what it does is it's not a static number then, because the way that portfolio values fluctuate, that number may be lower one year or higher the next. And but what it does is it helps a retiree really keep their withdrawal percentage in check and ensure that they don't overspend in that time frame.
Yep. And that, like you said, it's an endowment concept. This is what foundations, endowments, charitable organizations that say, I have a lump sum that I would like to last forever. How much can I take out a long time without depleting?
And it's really good for clients who really want to leave that legacy to the next generation or to a charitable organization. It doesn't work for everybody. Some people want to spend to zero.
Yep.
And that's a whole nother.
Or they can't, their withdrawing needs to be higher than what's sustainable.
Correct.
Yeah. So that's one way. Jordan, what's another way from a withdrawal strategy that we've utilized or that you've seen done that they track or know how to kind of fund that for them?
Yeah. So something that helps kind of set expectations for clients. Once you determine a good rate, whatever that is for the portfolio, there's an approach called a guardrails approach where you track that each year. And looking back, you see, okay, did that line up with that average rate that we're trying to stick to? And if you're under or over, depending on the returns in the market, you can see and you can kind of model forward too how that's going to impact your retirement. And it's really, I think the key there is just setting that expectation with a client so that they know when they're calling in or when they're meeting with us, they pretty much know what we're going to say regarding their spending because they have that number down. And they may or may not know what they're pulling out, but it's usually a lot easier of a conversation when we're making those preparations ahead of time.
And the next two pieces that we'll talk about, which is sticking to a plan on withdrawal strategy and then being tax aware of where and how you pull the money, is also kind of, we don't always know the answer at the beginning of the year, what the best time to withdrawal is. But if you have a good run in the market in your July and you're hitting all-time highs, you may say, hey, let's fund some future months worth while the markets are good to avoid that idea of taking money out when they're down. So, a lot of times having a plan on, I know what I need, but I'm flexible in how and when I fund it. So you're still sticking to the plan and withdrawal strategy, but then you add on top of it, just strategically saying, now's the time I'm going to fund that. I'm going to hold that cash and be using it for the rest of the year or 2 years or whatever you're funding. And then tax efficiency is, where do I get that money?
Yeah, it's almost like for tax efficient withdrawals, you need to chat with a financial advisor.
Yeah, or an accountant or somebody who understands that concept.
It's complex. It's probably beyond what we can explain today.
Yes.
But there is definitely an order of withdrawals that is the most tax efficient.
Or combining different types of accounts in a year so that your different income types are within your acceptable range of taxes.
Right.
So let's just get our minds around the fact that we know volatility will happen. It's inevitable.
Yes.
What are just a couple things off the top of your head that retirees should do and what should not do? Anything real quick?
Well, I'll say, when you see the market drop, having a conversation with somebody, because your fears in your head, you can build up and kind of compound on top. Oh no, this is happening. I'm going to have to do this and this. Just verbalizing it sometimes helps you work through it yourself. And so there's been times we've taken phone calls and a client really doesn't want to do anything. They just need to talk it out, right? Be a good listener, hear it out. So if you just have somebody you trust to have that conversation, say, you know what, this is what I'm feeling right now. Let's just work this out, right? And just talk it through. And then that's along with that, don't make any rash decisions. Don't let your emotion drive that decision. Give it a little time. Think it through, give it a break, come back to it.
Yeah, actually, sorry to interrupt, but yeah, the should do and should not do. The should do is stay calm, stay invested.
Yep. Yeah.
Should not do is check your portfolio daily.
Yes.
Right.
And I have a client who is really prone to checking their portfolio daily, especially in downward volatile times. He wants to know how much his portfolio is down, and I've trained him over years to stop it. And I broke through. And so the last bear market we had in 2022, he didn't look at his app, but he would call me and say, "Can I look today?"
Yeah.
Nope.
Just wait. Hold
today.
on.
Not
Hold
today.
on.
And then he'd call, another month or two later, "Can I look today?" Not yet. So it was a period of over a year before I was able to say, "Yeah, you can go ahead and look now." Right.
Yep.
The market did heal. It did recover, and we're fine.
Yep.
I think what the whole discussion highlights is the importance of having someone in your corner, right?
Yes.
So this is why working with a financial advisor is so important, because they have the experience, they have their credentials, they have years of bear markets. Unfortunately, everyone has years of bear markets under their belt.
Yep.
And they have put together a plan that will weather the next and the next and the next bear market. And if you don't have a plan, you're going to freak out. You're going to get emotional. You're going to sell at the bottom, and you're going to sit on cash when it recovers. And you're going to do all the stupid things we said not to do. But if you have a plan, you should have some peace. And that peace is something that we're passionate about here at Hickson Zerker Capital Management. So, yeah, any final thoughts, I guess, as we wrap up the discussion on volatility?
Well, you also need to understand, as you're heading into the retirement, you may have all the way up to that point said, I'm good. Market volatility doesn't bother me. There is a mindset shift. So you have to prepare yourself for that, because you could be prone to make a decision thinking, oh, it doesn't affect me. And then when it does, if you're not prepared for it, you could be more apt to respond to a bad decision. So acknowledge that volatility does affect everyone, especially retirees, in a different way. And that's the key.
Even more practical too, like you need something to do besides, like you need something to do in place of watching the market.
Yes.
So
Please.
like just on a day-to-day, like we talk about having these long-term plans, on a day-to-day plan during a down market, wake up, get your coffee,
Watch your
put your
grass
golf
grow.
pants
That's
on,
better than watching the market.
watch your
Play
grass
pickleball.
go, do something else. That can actually be beneficial for your mental health and your portfolio.
Stay calm, stay invested, trust your advisor.
That's right.
Love it. I love it. All right. Well, if you guys found value in our conversation, don't forget to subscribe to the Wealth Mindset Show on whatever platform you're on. That way you never miss an episode, and we launch them all the time, so you're not going to want to miss those. Also, feel free to visit us at thewealthmindsetshow.com for more resources, or if you're ready to invest with us, head over to hzcapital.com. We have a fantastic team of advisors ready and eager to help you meet your financial goals and to steward your wealth over time. We'd also invite you to follow us on social media and stay connected. And otherwise, stay connected, stay invested. And we'll talk to you next episode. Have a good one.
Bye.
Bye.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hickson Zerker Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hickson Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hickson Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.